Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, May 25th, 2023. It is 10:54 a.m. Eastern Time as I'm starting the video, and what I'm going to do in this one is an update on a few of the recently highlighted trade ideas. I'll talk about towards the end of the video, I'll get updates on natural gas. I want to talk about Treasury bonds and towards the front of the video. Definitely the stock market, what's going on with NVIDIA today, and so some of this will be somewhat new or different views of things I've covered, and then quite a bit is going to be a lot of the same. And for that, I can't apologize. The markets have been doing pretty much the same thing now for going on months, where you have just continued and to me extremely stark breadth deterioration, fewer and fewer stocks, namely tech stocks, namely big tech. NVIDIA now has leapfrogged, I think it was Meta and, one more. I'll get to that in a second. Drawing a blank. Feeling a lot better today. I definitely turned the corner yesterday, but I'm going off about 2 hours sleep. I'm still, not 100%. And last night was pretty much a sleepless night, but I am back and I'll be at my desk pretty much all of today. All right, I'm going to start out with treasuries and talk about rates real quick. And that's one of probably the most important things to watch going forward. There are times where the market kind of could care less. Remember, we've been in a uber low, an artificially low, a near zero rate environment for over a decade now, really since the financial crisis. The Fed took us down, to near zero rates on the short end, and that gave you a couple percentage points on the longer bonds, and kept us there for far too long. So it didn't really matter, if the Treasury yields went up, from 2% to 2.2 or 2.3. Now rates do matter. It's all about inflation. It's what's driving the markets. I'm going to illustrate that real quick. And so, like I said, I'm keeping an eye on Treasury yields. This is TNX. I'm going to roll forward a little. What you're looking at on this chart is you have in white, you can see up here, TNX. That's the 10-year U.S. Treasury bond yield. And in green, you have the S&P 500 or the stock market, right? So you can also do this and you get a little more volatility. When rates go up, the 30-year goes up a little more. It has a higher duration. Duration is just the percentage bond will move in response to a change in interest rate. So you can look at the 30-year as well. And so what happened really since COVID, you had everything going up. There was just all ships were being lifted, and then that sort of separated here. So you can see there's not a set on and off. Typically, historically, over the longer term, when yields go up, or actually, bond prices go up, that's yields going down, stocks and bonds moved inversely. And that's why you had forever and a day the old 60-40 rule work. That's where, longer term investors, pension funds, things like that would have roughly 60% equities, 40% in the bonds for a growth portfolio. So when the stock market dropped, that 60% of your portfolio you're going to lose money on, but the bonds helped to offset some of those losses. And that just stopped working in recent years. Excessive and artificial interest rate manipulation by the Fed. But here's what we have. So okay, we all know that the market's peaked back here. This is the S&P 500. It topped right about the beginning of 2022, end of 2021 right there. You can see the year break lines right here, or the January 2022. And at that point, you started to see the stock market go down. Remember, inflation was finally starting to be acknowledged by, if not yet at that point by the Fed, certainly by many, and the market started feeling it, started going down, and interest rates started going up as well. You can see what I'm pointing at here is a very clear inflection point. So you got that final leg up in the bull market right there, coincided with that abatement or drop in interest rates. Again, this is a 30-year bond. And so that gave that last shot in the arm to a dying bull. Call it, the patient on the ER table, and you give them a bolus or a shot of adrenaline, and you're gonna maybe get a little bit more out of them before they pass away. And that's kind of what happened there. So that final drop in rates gave you that thrust up, and I just want to show you the correlation sense. So you had stocks falling, and in response to interest rates rising. Remember, rates bottomed first and then started moving higher. You can see I'll put the line up there. So shortly after the market got that memo, it didn't like what it saw, because now, again, it didn't much matter for 15 years or so, but it did matter when inflation, it started to become apparent to most, if not all, that inflation was out of control. All right, and so rates were going up, the market didn't like it. And finally right here, you had the first decent abatement in interest rates. And right after that, remember, rates peaked first right there. And then shortly after, the stock market had its first big rally. And you can see how well that coincided with that. Right before that rally ended, and again, you can't make this stuff up. It's here. You can look at the charts yourself. Interest rates bottomed right there. That correction in rates, which was a rally. Remember, bond prices will be going up as rates are falling. And then as soon as it became apparent there was a turn, that rally ended. And you can see what happened. So interest rates shot up to new multi-year highs, and the stock market hit its bear market, to this point, bear market low. The peak in rates was right there. The bottom in the stock market was right there. Okay, so this is now, I think I've established, it's far from mere coincidence, right? Then you had a the biggest correction in rates at that point. And you also had one of the biggest rallies in the stock market. And you can see all the little turns. Do it yourself. I'm just drawing the arrows here. You can see an unmistakable correlation there between all these peaks and troughs in both. And so lately what's going on is you can see rates are compressing. I've showed you that the 10-year, which I'll show you again, long-term bonds are at a long-term trend line support. My view is long-term, I have a high degree of confidence. When I'm looking out years in advance, I have a high degree of confidence that rates are going to be even higher. We're going to go higher. That's not set in stone. That's just my view. That's my read on the charts. That's my read also from a fundamental perspective. We'll see. Only time will tell. Near term, I suspect we're probably going to see rates break above this range. So we want to watch that, and you can see the stock market has kind of been waiting to see which way we go here. And you can see there's that trading range in the 30-year. Let me put the 10-year back on as well. That's one to really keep an eye on too. Okay, this is TNX. I watch them all, but they're going to move roughly in lockstep. Like I said, you're going to have a little bit, typically more of a response on the 30-year. It's going to go up or down more than the shorter term, the 10 or the 5-year, but usually in the same direction. Again, usually. So we're going to watch that. And what will, right now we've kind of flattened out into a range, and you can see the stock market too is flattening out. Remember, QQQ, once again, is the farthest thing from the stock market. At some point, it really shouldn't even be considered an index because they've let it get so top heavy. They ought to just, apply, tweak the cap weighting to it. There is an equal weighted, but maybe, I don't know how to figure that one out. Either way, just keep that in mind. It's not the economy, it's not the stock market, and that's the whole gist of, the importance of why breadth and market internals do matter. There is no guarantee after a period of extended negative market internals, negative breadth, that you are going to drop. But historically, that is usually what happens. So that's why I'm still expecting another leg down. But where I'm going with this is the catalyst here, if we're going to break out and have another leg up, and what the market will react to, I believe, are taking out these previous highs right here. There's the first big reaction high. At that point, it will start to become clear that we have a new uptrend. Right now, again, it's a sideways trend. And until and unless you take out that previous high, it's anyone's game. And of course, if you take out these lows, you can see there's nice support there. That means falling yields. That should be bullish for equities. And I have to put the should be in quotations. There's a lot, again, the Fed's kind of turned the market and the bond market and price discovery and all that upside down. And of course, DC as well. Right now, we'll see what they do with the debt ceiling. So it's a big thing to watch, in my opinion. Okay, and here's the 10-year yield on a candlestick chart. This is my weekly time frame. This trend line right here goes way back to the left. My weekly will only zoom back to 1995, but that's the secular bear market in interest rates, which again is a bull market in bond prices that started back in 1981. So we're looking at a multi-decade trend line there, and that was just taken out. And I can make the case, if I wasn't telling you that, I wouldn't be honest. I can make the case that we could drop here. You have a pretty steep divergences building right here. But we are at trendline support, and we did just break out recently, fairly recently, of a secular bear market downtrend line. So what I could see, my most bearish scenario for Treasury yields would be we break that trend line, back test here, we could grind around for a while, and then ultimately go up. However, if we do this, and this could be, we could Treasury yields could shoot up if something goes awry with the debt ceiling talks and how they resolve that. You could see a lot of pressure. From what I've read, it's almost, and there's a lot of articles out there, and they all make sense, from a fundamental perspective. But obviously, they're going to come to an agreement one way or another. The U.S. is not going to default on their debt, and there's go-arounds. I'm sure you've read about that. The $1 trillion coin, whatever that certain amendment is that president can invoke. There's ways to get around making sure we don't default, but they're not good alternatives. So, if for whatever reason, the rest of the world who's buying a lot of the U.S. Treasuries doesn't like it, then when you don't buy something, there's less demand for something. That causes the price to go down, and the price of bonds, with a little dollar sign here, goes down. Yields, which is the percentage that they pay, goes up. So that's one scenario. And the other is, even if they increase the debt ceiling, this was interesting. I wasn't aware of this, that they increase it by another $1 trillion or whatever. The Treasury then has to issue $1 trillion more of Treasuries to replenish the coffers, and that in itself can cause rates to go up. Now, that should be priced in already. So, I don't know how much of an impact it's going to have. And again, I can't tell you for sure which way this is going to go. These divergences don't have to play out. You do have the PPO back testing the zero line right here. Maybe you put in a divergent high at higher levels down here and then correct at a higher level. Again, just something to watch. If I had to take my best guess, I'd say we're going to have a breakup out of here, and that will coincide with the next leg down, because we're still where we were several weeks ago, even several months ago. And if I sound like a broken record, I can't control what the stock market does. The stock market is trading where it was today. It was trading there. That's 4 months ago, and almost this is right here. Go back this far. It's trading where it was 9 months ago. So that's that. And if you're frustrated, welcome to world trading. It's not always, this is a trader's market. This was an extremely profitable market to trade the indexes. It's since become a stock picker's market. And one thing I'm going to do here, now that I'm back online, I've got to tell you about another vacation coming up. So I forgot to mention that one before, but I did have one planned. It's starting next week. Short one, a little mini vacation. I do those quite a bit. Anywho, uh, where I was going, I'm going to start to work up some type of get something out to you, maybe at least on a weekly basis with two columns. Bullish slash long setups and bearish slash short setups, and I'll break it down. My favorite, top sectors, whatever number it is. I never force a trade. I won't put out 5 bearish sectors and 5 bullish sectors every week. That's ridiculous in my opinion, because if I look at the charts and nothing stands out, picking 5, it's not worth it. If I can't make a strong case to go long or short something, then stand aside, wait for the next setup, and then I'll also pick some of the top picks in those sectors. And I'm not just sectors, obviously commodities as well, fixed income, crypto, anything falls into those categories. So I'll start to do that as well, because this is a stock picker's market right here. When you go, sideways for a while, this is a, swing traders market when you have these big rips and dips. And, I personally did very well. I think a lot of you did very well. Gaming, good part of those. And this, so far has been frustrating to some. I realize that. For a long time, we've had these divergences building. They look like they're going to play out. But we're still at where we were a long time ago. Even back here, we've hit the upper end of my bounce target zones. I'll go to SPY. We didn't even exceed it on SPY. We're slightly above it, or took it out slightly. That's my max bounce target zone back from earlier in the year when we bottomed here. And we're still well below that. So, that's a combination of Fibonacci retracements and price levels and reaction highs and a lot of stuff, long-term trend indicators. So that's that. Okay, now let's beat that dead horse known as negative market internals. Let's look at the Qs. So the big news today, NVIDIA, who's now bigger than both Meta and Tesla. So it is the now fifth largest stock really in the U.S. It's Apple, Microsoft, Alphabet, Amazon, and then NVIDIA. So it's up 27% today. And like I said earlier in the video, to me it's been a series of rolling bubbles. AI is nothing new. All of a sudden, when ChatGPT came out, and it's just another iteration of technology. Alphabet, all these, many companies have been using AI. Artificial intelligence has been around for a long time. It's impressive to have something write a essay for you or complete a job interview and things like that. And is it going to change things? And yes, absolutely. But it's just another iteration of technology. Look, that's my opinion. NVIDIA happened to be the leader. So again, even in the tech sector, the semis, as I showed you, it's pretty much a one-trick pony with NVIDIA. And you look at QQQ, and I'm going to show you this now. Let me pull my list over. Let me move this like this. I'm going to drag this window if I can show you this. This is my real-time breadth indicator I came up with years ago. It's simple to use. It's when you're looking at market internals, I don't know nowadays. I've been doing this for a long time. It used to be NYSE or S&P 500. I don't even think they had it on the NASDAQ composite. Certainly not, again, years back. I don't remember it being available on NASDAQ 100. But if you use a charting platform that will sort everything, you can queue up in this particular platform. You can queue up any ETF, look at all their holdings. So QQQ is going to show you the 100 stocks in the NASDAQ 100. And then all you have to do is sort by percentage gainers or losers. And so there's 100 stocks. You can see that in the very bottom of the screen here. Unless that's cut off right where my cursor is, it might just be cut off, but it says 100 items in the watch list. So then what I do is I click on the last of the green ones, and that tells me now it's improved since actually this morning. It was considerably lower. It was in the 30s. But still, only 42 out of 100 companies in the NASDAQ 100 are trading green. And yet the NASDAQ 100 is up 2.5%. So usually 42% of companies are green. You would expect that that index, whatever index it is, if 42%, you're going to be down a little. sometimes up a little with the weightings, but typically down, and that's a stark divergence. So QQQE is a simple way to get quick breadth indicators. Earlier this was negative. It's still up only 1/4% versus the what I tell you, 2.42% gain. So that's 8, 9, 10 times, almost 10 times the returns in QQQ, a la today NVIDIA. So again, I know I'm beating a dead horse, but these things matter. I've been doing this long enough, and I'm sure you've heard it elsewhere now, that it's a red flag for the market. And I wish I could tell you that I can guarantee the market was going to crash or come down hard because of it. You just can't. If that was the case, I'd say take all your money, or I would tell you, I don't tell you what to do. I'd tell you that I'm taking all my money and I'm putting it into selling naked puts, or selling naked calls, or buying outright puts, leveraging up as much as I can. But that's not the case. Once in a while, you can see the rest of the market start to play catch up. But this has been persistent. And the longer it goes on, typically the harder the market falls. All right, let's move on. So that's the P. Oh, well, let's talk about QQQ while I'm on here. So here's where, let me turn off all the lines here. My last day of vacation, I came back over the weekend. So we had that spike on Thursday, Friday. So we're technically, well, the day hasn't closed yet, and you can see, but we're right about where we are. So this, if we can power on through here, we've now taken out this recent top right here. You can see 3 candles around that level. We're trading, for all intents and purposes, right on there right now. If we close the day solidly above there, it's going to be hard to argue. And that's where, as I mentioned before, if you wanted to take a shot earlier, I gave you, I think it was yesterday, kind of a trading plan, if you will, where to, if you are, looking to short, where to add to those shorts. So it was scaling, I think 3 points down below. You could take, like I said, first shot here, with a stop, somewhat above. Second one would be if we fall back into the trading range, which is right here. So one, be a 1, first lot, second, third, and then you can either do a single stop, or I like to layer stops. Typically I like to scale in, scale out of things. And so we'll see how the day closes today. Oh, and the rest of us, as far as the rest of the stock market, you have the small caps down 1.3%. This, the small caps kind of do their own thing at times, but overall they're stocks and they tend to follow the stock market. Again, this is unusual, and then you can see IWM is in this, still locked into this trading range right here, and it's headed down. You had already got rejected off the top of the range, and it's headed down towards the bottom of the range. So what you want to watch for on the small caps is first a break, right here. Here, I'll give you levels. Let me turn on the lines here. Let me give you a different board. There it is. I have that one. I need to move it down just a bit, about 172. And then there's a couple spike lows down through there. So, but you can see a lot more candles around that 172 level there. A lot of reactions, even back here. So, more of a range, if you will, maybe all the way down to 170. So watch that for IWM. But that's still below its 200 days, and that's again showing you that the overall stock market, most stocks are not doing well, and just a handful of big techs. And really that's what I've heard cited as one of the primary drivers of Microsoft and Alphabet. Alphabet finally rallied. They didn't do so well after earnings, but then when they did their, was it IO, that dog and pony tech show they do once a year, they introduced their AI, which again, I think they undermarketed themselves. They've been using AI for years, a lot of the products, but it was as if they didn't have any AI. And that's when they started playing catch up. So like I said, it seems to be just another bubble, and AI, again, AI is here to stay, but it's also not anything new. It's just another iteration or improvement of existing technology, which has been improving for a good century now. Okay, I'm going to get to those the gold, natural gas, some of those things I covered recently. I already covered the Treasury bonds. Let me just, I've had a few alerts go off today, and let me get to those. My internet was out for a good part of the morning, so I'm back up and running now. Let me go over the alerts that I've had in the last couple of days here, including today. I had Target fire off today. I want to point this one out. It's getting really close to breaking down there. That's about 138. My line says 137.94. Everybody loves round numbers, so let's make that 138. Nice little support shelf, even a big gap back there. And again, this isn't just ABC Corporation, and that sells widgets in the middle of Kansas. This is Target. This is a big retailer, and this speaks to the economy. I told you on my radar, one of the big sectors I'm watching is retail stocks. XRT is the big retail ETF. And I'm seeing continued breakdowns across the board. Target, they have like Walmart, Walmart, if you follow the headlines, Walmart's been closing stores. So is Target with all the, ever since the, the riots in the last couple of years, defund the police, you've had just massive theft, people walking out boldly in the middle of the day, carrying out TVs and everything else. So the one store that's been immune to that is Costco. You have to have mostly immune to it. You have to have a membership card just to get into the store. And even Costco just broke down. So we know, Walmart's had their issues. Of course, the CVS's and the Walgreens and the Targets. Target's a big one. And you can see now Costco, I mentioned this one just broke down from that symmetrical triangle. I'm just going over my, on another window here, my alerts have gone off in the last couple of days. ADP, I told you I'm keeping a close eye on that one. Looking pretty weak, and looking to see it take out this previous low, and ultimately if it can take out these divergences. You do have some potential divergence down here, so I'm watching it. I don't have a position in this one now. It's more of one to watch for me. But the retailers are looking pretty weak, and I think you could certainly take some exposure there if you were inclined. What else do I have here? ADP covered, AZO. Let's see. There it is. AutoZone. I just had an alert on today. Just now breaking down. I wouldn't short it yet because although we just cracked this trend line I have here, let me zoom in, grab my screen draw tool. This is the trend line. This gives us a wedge, a big wedge. That's a multi-year trend line. Goes back to the COVID lows right there. And, enough reactions to validate it. But thing is, this one performs very well to the 200, or behaves very well to the 200-day moving averages. That's the red and blue lines right there. And you can see, boom, had a little spike there, but it got right back above there in a couple days. So that was just a whipsaw, and that also helped validate this trend line. And every other instance it's hit those levels. Other than that one little whipsaw, since COVID, the buyers have stepped in. That makes that a significant level. Therefore, pretty much anything much below today's lows right here would be a sell signal. So you can put that one on your checkbox as a trade idea. Here's a divergent high right there. Like a lot of stocks, and I'll admittedly tell you, I thought, we had a lot of divergence on the indexes and everything. It started back here. And so the story is, we've gone on to just make marginal new, just slightly higher highs. This one put a little trading range when it did it, and pretty much just extended the divergences that were already in place, just like the stock market. So that's what it looks like. And typically, the bigger the divergence, the bigger the drop. If I wanted to take a guess, well, I'd just use a measured target to get the measured target of a bearish rising wedge pattern. You take the distance, the widest part of the wedge, which would be about right there, give or take, and you add that to where it breaks down. And that would take AutoZone down to right about there. You got some reactions as a support level. 1962, and give you about a 19% profit on that short if it's hit. All right, a couple more Qualcomm, I mentioned yesterday. I'm going over again the ones that, this is my watch. These are all the alerts I had triggered over the last week. Not all of them, but some of them. Qualcomm, it's cracking that level I showed you yesterday, support about 102.66. And there's another big former, golden child of the semiconductor sector. They were big on cell phones, chips used in cell phones, and everybody's on AI right now. So if you're not into AI like NVIDIA, then that's where most chips are not doing so well. Ferrari, I like this one. This is an actionable short trade. This one triggered, it broke down below that 289 level, it broke down below the trend line. If I wanted to do benefit of the doubt, I pull it down here and I catch that candle right there. Tighten this one up a little bit. Anyway, I cut it, we're below that trend line. So that is a actionable short trade. You can short it now with a stop. Give your stop. It depends on what you're targeting. I think at least it's coming down to 256. That would be a drop of about 10.4%. Quite possibly, or quite likely, a lot more. Also looks like a little flagging action there. When I see something like this on the daily chart, I go down to the 60-minute chart, and then I zoom in and see if it looks like a clean flag. It's a little sloppy, but you see where I'm going with that. Bearish pennant more likely, or no, you can do a flag. Look like a bear flag like that. And you don't see candles there. It's a gap, but a gap, the only thing more bearish than a straight down, bunch of red candles is a gap. Gaps are very bearish, especially when they come at an all-time high like that. What it does, it traps. It trapped everybody that bought right here. All these people, individuals, investors, institutions, whatever, they all got trapped in that gap. And so they're all waiting to get back up, break even. And that's what a reversal will do. And then, sooner or later, as you continue to move lower, they start feeling the pain. They stop out, stops are hit, they sell. So anyways, that one I think is going down. Fiserv, I believe I gave you yesterday. It's already hit that, there was the breakdown right there, coming up with that 114 target. Next stop, about 110.90, and quite possibly more. I'll update it later. Just, trail stops down on things like this if you're in it. Pepsi or ISRG, did I cover that one? ISRG, solid breakdown, impulsive breakdown, minimum target 290.54, and then most likely it's going to get into this gap, and gaps once entered are usually backfills that take you down to 270.35-ish or so. What do I have next here? Pepsi is just, here's a bluest of the blue chips right there, and it's in free fall. So, that kind of shows you what's going on with things. If you're not tech, if you're not AI right now, you're in a lot of these stocks. Well, you can't call this one in a bear market. Pepsi, the thing about Pepsi, this is one of the king of the defensive issue stocks. You go into recession, people, you don't stop. This is one of the things you usually don't cut out. People that are Pepsi drinkers are going to keep buying their Pepsi. Some people stop paying their heating bill before they'll stop buying their Pepsi. So, rightfully so, it went up, even with talks of recession, but that's a powerful breakdown, and they're just selling. And I don't see any, it's going to have a counter trend rally sooner or later, but my minimum target, I think, as I said yesterday, is this trend line, that uptrend line right here, and the 177-ish level, which come in together. Booking.com, breakdown backtest. I covered that one yesterday. It's still moving lower. Still looks like it's going lower from here. Starbucks coming up on that. And there was the breakdown coming up on that $97 target. So that's it. Applied Materials, they're getting a little boost. Because what happens when today, because NVIDIA and everyone's giddy with the AI thing and NVIDIA's results, and it's an impressive move, but just like QQQ is going to go up if Apple blows away earnings because it's the biggest component, NVIDIA is by far the largest semiconductor, by far, not even a close second. So it's bringing most of the semiconductors up that are in those semiconductor ETFs due to the buying pressure on the ETF. But, we'll give it credit where credit's due. It entered the range. It's back above it now, but it did just put in a divergent high. And let's see if this is just a one-day pop, which I suspect. We'll probably get back into the range. This is big divergence. This is what, I don't know why my lines, they sometimes drift. They just randomly decide to move on this platform. But there's the negative divergence. And, like I said, no guarantee it plays out, but usually does. And that should take Applied Materials on the next leg down. And keeping a close eye on that one in KLAC, because those are the two of the big chip equipment makers, and they kind of give you a tell on the overall chip industry. Okay, all right, let's wrap this up. A quick update on natural gas. I wouldn't buy it now. It's a little below that uptrend line. I want to see it get back above there. If it does soon, you're going to have positive divergence. You do have, technically speaking, but it's not confirmed. I want to see this PPO turn back up, and I want to see us get above this uptrend line, because I told you the other day that was, time to get out. It rallied, hit that target. By the way, I've rolled it since my last update. Now we're on the July's last contract is now expired. This is the current one. And so you have potential divergence. And remember, it's constructive on the daily chart when you look at UNG. So, if you want to take a shot at it here, but again, I really would prefer to see it. I told you, the most objective entry would be on a pullback to the trend line. Now, the day's not over. So when I zoom in on that trend line on UNG, this is a daily candle. It's not yet finalized. So if you can get back on there, remember, we just put in a big divergent low, and natural gas has gotten cheap. This is UNG. It doesn't track perfectly because it's an ETN. I'd have to go back to those futures charts and zoom out, but it's down near multi-year lows. So there's some value there, I believe. But I've said this before, never, ever get married to a natural gas trade. This thing can go up a lot more than you think. It can go up 10, 15% in a day, and then do it again the next day and the day after that. It's what I call a trendy little sucker. Sometimes it'll consolidate, but quite often this thing is usually full throttle up or full throttle down. Now, we're not full throttle up yet, but what it'll tend to do, if you start breaking these support levels, that's where it'll usually start to accelerate. So either way, I'm still on my radar. And, I still have, I did add back a little bit yesterday, and I'm not adding right now. I want to see it get back to that, up above that trend line before adding any more to it. And then gold and silver, like I told you, this is my busy board on gold, but there is some support there. I think gold's ready to mount a bounce. I have some divergence on the 60-minute chart, so I think it's worth a shot maybe to, if you didn't cover the shorts already, remember, for me, I've been short, covered my GDX short yesterday, I think it was, and some of the metals, but looking to go long now. Right here you have 60-minute divergence, not confirmed, but that PPO crosses over soon. It will maybe carry a little bit lower. That's 179.85 as support, but we're close enough. Sometimes when I see something like this, do I want to hold out for another 0.37% downside? And then I'll also look at the futures and say, well, on that, my comparable support level there is about 132.40. You can see very, very close. Let me refresh that, make sure it's up to date. And I'm going to put that line about, that's about where I had it, 134. See, close enough to support with 60-minute divergence. I like it here. I like gold right here. Cover the short if you did short it off the divergent high, or again, this is just me. You can keep a tight stop below there, a little bit more liberal. If it breaks that level and keeps going lower, I'll give you my thoughts. But I think we're gonna looking good for at least a counter trend bounce. Another thing would be if you the markets start getting a little riled up about no deal on the debt ceiling, gold will probably start to catch its typical flight to safety bid. And then, as always, if gold goes up, not always, but usually, silver's going to go up with it and usually go up more. So silver has this 3-month chart Nice divergence. That was at support resistance level before I left town. I think I told you about that. If we broke it, you're going to go down, and was targeting at least the bottom of that range. So now you can see some pretty big positive, aka bullish divergence building here on silver. And so where to? I certainly think we'd get a reaction if it bounces all the way back up here, 24,883 roughly. And if so, that's about a 7, almost, yeah, right about an 8% pop if we get there. So same thing, don't get married to it, but take a shot, have your stops wherever they are, whether it's one stop or multiple stops. If you're targeting a 7% bounce, then you can give yourself a 2-3% stop loss, and that's an attractive RR. And then last but not least, the Euros also has some nice divergence on the 60-minute chart. You know me, I like to always keep an eye on the Euro-US dollar pair because it is positively correlated with gold. So if this plays out, we get a rally there, and gold and silver will most likely rally as well. We are a little bit below that target / support level I had there. But we're also on this 200-day moving average, which actually has done a pretty decent job of containing pullbacks in the euro since it took him out right here. You can see that the 200, the red line, the 200 simple. So there, you might get a bounce there. And getting close to oversold. Last time we were this oversold was right there, and that's when the euro bottomed. And so what could cause this? It will certainly be something that the markets don't like with what's going on with the debt ceiling, because that's going to cause the dollar to go down and the euro to rise against it. Of course, it can go the other way. So again, I have to caution you, if you're trading dollar-sensitive assets right now, anything that's going to be impacted by, amicable resolve or lack thereof to the debt ceiling, then stand aside if that's not your cup of tea. All right, I'm going to wrap it up here, guys. This has been Randy Finney with Right Side of the Chart. Have a good day.